it was really bad timing.
As you've probably heard, Silicon Valley Bank sort of imploded a little bit, and then the FDIC got involved and the Fed got involved and like the California state authorities, because Silicon Valley Bank, well, it's sort of complicated, but I'm here to make it, or Sarah, I should say, is here to make it not so complicated so you can understand what happened with that bank, understand how it affects you, and basically answer all like your general questions about it. I'm going to introduce Sarah Paulson of Valkyrie Financial. Sarah, can you give us a quick intro who you are and what you do?
Absolutely, Kate. My pleasure. Hi, I'm Sarah Paulson. I am a certified financial planner, which is a pretty highly regarded designation in the financial advisory industry.
I do have another video I will link to about how to find a good financial planner, but like basically everything I say is like find somebody like Sarah. But you should watch the whole video though, because there are a lot of things that you want to be looking for. But that's why I invited somebody like Sarah here, because they're the kind of financial advisor that I trust. What the heck happened with Silicon Valley Bank?
Because I am a registered investment advisor, anything that I say here is not to be taken as a recommendation for you, because I'm not actually your financial advisor, and that past performance is no indicator of future performance. It is educational information. Exactly.
Yeah, don't take investment advice from YouTube. Actually talk to somebody like Sarah.
Yeah, or Instagram or TikTok. Just don't. SVB, they are a bank in Silicon Valley, hence the Silicon Valley Bank name. Mm-hmm. And they imploded, like Kate said, pretty much within 36 hours, based on a double whammy of bad market timing and raising interest rates on bonds. Bonds are like you making a loan to a company or a government. And with rising interest rates, the Federal Reserve has been raising interest rates in an attempt to drop the inflation. So what they do is they raise interest rates so that companies have to slow down. And as there becomes less supply of money, then we pull out less demand for money as well. It's this whole fun interrelationship. Raising interest rates is a super, super blunt tool, but it's what they've got. It's what they use.
It's a blunt but powerful tool.
Powerful. This is a sledgehammer. Absolutely. Why that's important is because bonds have a maturity date. And when an old bond is chugging along, paying out its interest rate, and then someone like the Federal Reserve comes out and says, well, now bonds are going to be paying a higher interest rate, investors automatically want the new shiny higher interest rate, right? Why would you want the same thing that will pay you less?
Yeah, that makes no sense. You want to get
paid more. Absolutely.
It's like, do you want a large pizza for $10 or a small pizza for $10? I will take the large pizza for $10. Thank you very much.
Yeah. So keep that in the back of your head. Okay. What's also super important to understand here is that Silicon Valley Bank was very niche-y in that they catered to Silicon Valley startups, venture capital, tech companies, and cryptocurrency, which worked really, really, really well for them in the years before COVID and the early years of COVID, when we all swarmed online because we couldn't do anything else and we didn't want to be with our own thoughts, because that's a scary place. So let's turn to the internet instead. We could easily argue that these startups, these tech companies, got a little overexcited with all of that attention, a little bit, and they grew too fast. So these past few years, past really 2 years, they've had to kind of rein things back in, become a little bit more reasonable, come back down to earth, which means that these companies that bank with SVB haven't been doing as well. They haven't been doing the bank deals that SVB makes money off of, mergers and acquisitions, and initial public offerings are big money makers for banks. But it also means that these companies aren't making as much money, so they've been pulling out cash from their bank accounts to cover up the hole from their operations.
So this is, I mean, people have probably heard about how big tech companies have been laying off a lot of people. So this is like all one and the same thing going on. They're just trying to cut back on spending, and so they're taking out more of their money from the bank. Okay, all right, I'm with you.
Yep. Okay, so banks have what's called a cash reserve. It is regulated by the government. They have to have such a percentage of funds in cash on hand for their customers. Everything else can be invested in very strict regulations. They can't go crazy and like bet on the next cancer drug. No, these are super safe things that they can invest the money in, but they still have to have that cash on hand for their clients to draw out. Problem became that SVB's clients were pulling out more money, more cash than SVB had in their cash reserves. So in order to make up that hole, to get more cash, they had to go into their investment portfolio and sell assets, stocks, bonds, to make up that hole and get more cash. Mm-hmm. The problem there is that they had older bonds. Remember, we now have these new shiny bonds that are paying you more, that the market wants more than the old bonds that Silicon Valley Bank was holding. So they sold those bonds, but because people didn't want them as well, it actually became a loss to the bank. They got less money than they had paid for it, which creates an operating hole.
All right, so like, yeah, they bought Beanie Babies in like 96, and then it was 2002, and they were like, hey, you want this unicorn for $300?
Princess Diana, purple bear.
Everybody was like, no. Okay. I'm with you.
Cool.
So they took a hit when they sold, because they needed the cash. They took a hit by selling those bonds early.
Right. If they had just let those bonds mature, wouldn't have been a problem. We'll come back to that. So because they had this hole now in their budget, in their cash balance sheet, they went to their venture capital friends. They're really frenemies, but they thought they were friends, and said, hey, does anyone want to invest in our bank now? We'll give you shares, you give us money so that we can keep this thing going. The venture capital firms kind of saw the writing on the wall and thought, that's not a good sign, which it's not. Yep. When they have to do kind of a fire sale like that. It's not unusual, but it happens, and it's not a great sign. And those venture capital frenemies then turned around and went to the companies that they had invested in that are holding their cash at SVB and said, hey, there's a problem here. You need to get your cash out now, which creates this whole cycle for SVB. They were already low on their cash reserves, and now more clients are pulling out. It's a classic run on the bank.
Okay. Yeah. So if the bank could just get a little bit more money, they would have been fine. But since people found out the bank needed money, everybody took their money from the bank, just making the problem that much worse.
Exactly. So it was really bad timing.
I have a student loan forgiveness cheat sheet, as well as a 24 easy money moves download to stress less, save more. Get them at my link in the description. So that makes sense for how that sort of just suddenly crumbled. Tell me, what is the difference between this and 2008?
Totally makes sense to draw comparisons between bank failures in 2007, 2008, and what's happening right now, which is understandably terrifying. I will preface this by saying that one of the most dangerous statements in investing is, but this time is different. But there are some key differences.
But we will tell you the differences.
So we learned a lot from the banking crisis. There were rules and regulations put into place so that SVB wasn't doing those shady deals. They technically weren't doing anything wrong. They
as
weren't
far as we know, that only happened 6 days ago.
Yes.
So if you're watching this in the future,
Mhm.
more information could have come to light. But as of what we know right now, on March 15th, the Ides of March, fun. This is what we know, that nobody actually did anything illegal or
Right.
wrong.
Their loans were well capitalized, which is a whole banking term, something that they really focus on. They weren't making subprime deals. They had all of their other funds invested in very safe bonds, things that weren't supposed to fail or lose money, but they got hit in this bad interest rate timing.
Mm-hmm. Yeah, it was just sort of a perfect storm of events, and yes, definitely some human error, but not necessarily malicious human error, as again, from what we know
as
right
far
now.
As we know,
as far as we know right now.
Yes. Yes.
Okay, so people are probably really concerned about their own money, because all the banks are very interconnected. The banking system, the worldwide banking system, I mean, that's why 2008 was such a huge disaster. There are reasons for which we won't go into. It does actually make sense for all the banks to be so interconnected, but you know, there's always good and bad. Do people need to be worried about their money?
Most likely not. So we have this thing called the FDIC, stands for the Federal Deposit Insurance Corporation. And even though they're a corporation, they are a government entity. They're created by Congress. But don't worry, they are bipartisan and divorced from politics. They truly just look out for the interest of the American consumer and depositor.
So would it be fair to say it's like kind of like the post office or like the Fed?
That's a good comparison.
Like, okay.
Yep. So they are an insurance corporation. So just like you and I have to carry insurance on our home, our auto, banks have to carry insurance on their deposits. So they all pay into this corporation, and they hope they never have to use it, just like us and our insurance. But those funds are there for if someone else has a misfortune or an accident or an issue. And just like our home and auto insurance, there are caps with how much our insurance will pay out. The FDIC has their cap at $250,000 per account holder. So if you're a married couple, that's $250,000 each. $500,000 in deposits in cash at a bank is insured, so that even if that bank fails, you will get that much money back. Now, most humans in the United States should not have that much in cash. If you have that much in cash, please talk to
Sarah.
me.
Please talk to Sarah. Holding that much in cash as a person, as a human being. Like,
yes, there are other ways to do it. We could also spread it around. It's a whole thing. So people should not be worried about that. The FDIC has stepped in. They are doing their job exactly like they are supposed to, and they have insured those deposits. They are also, because now this flag has been raised, regulators, the industry, investors, really smart people are combing through all of the information to see who else this could possibly be a problem for. SVB was the headline bank that shut down. It's very rare because it's a big bank. It was the 16th largest banking institution in the United States. There were two other smaller banks that went down with it because of the interconnectivity. But it looks like at this point, we are mostly contained so that other banks will not be affected.
Silicon Valley Bank stuff, as a normal everyday person, you're protected, like your money in the bank is protected. But what about investments? Because the stock market seems to be on a pretty big roller coaster right now, since the banking and finance industry is such a huge part of the stock market.
Yeah. And before I answer that question about the stock market itself, let me just say that your investment accounts have a similar protection to FDIC. It's called the SPIC. And this doesn't protect you from investment losses, very different thing. But if the company that holds your investments happens to go down, That was more of a problem in 07, 08. Up to $250,000 investment value is protected. So people don't have to worry about their 401ks, their IRAs nearly as much as they might think. There's protections on those as well.
Okay.
But getting to what the stock market itself is doing, yes, roller coaster of emotions right now. We are between the lows of, oh my gosh, the sky is falling, panic. What else is going to be affected by this? Our company's going to be locked out and not be able to access their money. And then that's going to affect payroll, and it's going to affect layoffs and the whole gamut. Those are the lows. The highs are that the Federal Reserve is going to have to slow their roll on interest rates raises right now. They've been raising, like I said, to try and control interest rates. Mm-hmm. But that also makes it harder or more expensive for companies and humans to take out a loan to buy a house, or for a company to put in a new piece of equipment, or to build a new plant. So keeping those interest rates low is a really good thing for business, because they can do more expansion at a cheaper price. And the stock market is pretty excited that, hey, we might get to keep doing expansions and other capital projects at lower interest rates. So that's the high. If anyone has any questions, by all means, reach out to me. I believe, Kate, you're going to put my website in the comments here.
Yes. So check Sarah's website is going to be down in the comments. She actually has a hilarious page. The contact me page is really fun. Like, just go, contact, even if it's just to say your contact page is hilarious. But yeah, Sarah, you are available to help people. Can you tell me again who you would help, like what you do for people real quick?
So this is a little different than when most people think of a financial advisor. Usually advisors get paid based on how much money they are managing for you. That makes it really difficult for someone just starting out to get good advice. So I do my business a little bit differently, and I charge a subscription fee to most of my clients, which means that if you have an income, you should be able to get good financial advice. And I serve millennials who, we all know that we weren't taught money, but we know we should be doing something. That's where I am. I take the shame out of it. I do not judge you. I have yet to hear a stupid financial question. There are stupid questions out there, but there are no stupid financial questions, because it's something you've never learned. So those are the people that I help, and those are people I love working with.
Okay. And you do offer like a free 45-minute just to talk and see if you're the right person to help.
Absolutely.
And whatnot.
It's like a first date, but hopefully a lot less awkward. Yeah, it's a free consultation. Just figure out what's going on in your financial life, and am I a good fit to help you figure it out?
Awesome. All right. Thank you so much. Really appreciate you explaining this. It can be really complicated, or can feel it can feel really complicated. But it is important that the average person does understand this, to help understand, like you said, nobody really teaches you about finance,
right?
Because it's complicated. Like, it is intentionally complicated. But you should understand these sort of basics about bonds and interest rates and how banks are interconnected, because it does affect you ultimately.
Correct. Yes. And your future.
And your future.
It's pretty important.
Thanks for watching. Cheers.